What's going on, everybody? Just checking over some stuff here. Good day here in the market. I mean, we had some stocks really ripping on our list today, didn't we? Encana's definitely making some moves here finally. Energy stocks in general getting a pretty nice bid. It's pretty good timing on our Devon and Encana buys back last week. But yeah, pretty strong day overall, right? Baidu was up almost 5%. Macerich up about 4%. Lear up 4.5%. So yeah, quite a few big gainers here. Only a few in the red. I noticed Sunrun and SunPower have been kind of in a downtrend. Yeah, anyway, I'm going to wait about another minute or so before I start the actual recording here. But yeah, oil and gas definitely got the love today. Definitely got the love. It's interesting, too. So crude wasn't really up that much. Natural gas had a nice 4% pop. So that's definitely helping the sector. But I think a lot of the sector is just so unloved, and there's so many people that are either short or just not don't have any investments in the sector now that, you know, there's like this FOMO buying happening on anything positive in the sector. So there's actually a lot of trashy oil and gas names that were up a lot today, like stuff like Range Resources and Antero that are like really beaten up, but they're companies that are like levered, like they're not only levered from a balance sheet perspective, but they are focused on like they're either gas heavy or non-crude products essentially that have been like even weaker than crude prices over the past year. These are the companies that are most exposed in those sectors, so they've been some of the most beaten up. Like if you look at this chart of Antero, the thing's down like 90% in a year or two. So yeah, so I've seen a lot of these kind of junkier oil and gas names getting a pretty big move in the last couple of days. But no, we got a nice one here with Encana too. It's funny. I'm going to talk about this one once we get started. But Encana had some interesting news last week and pretty much caught the bottom on it last week, assuming that is the bottom, in the near term. But I'll talk about that one in a minute. Still, I mean, look where we are though from a broader perspective on Encana. It's still pretty undervalued. I mean, I'm below my average cost. So anyway, well, let's go ahead and get this thing started. Let's make sure we get recording going. Welcome everyone. This is our stock market weekly update here on November 4th, 2019, and we've had a couple time changes, so hopefully we get that all figured out as far as the starting time. But good to have everybody joining me. Good to see you again, OCY. We missed you on the last couple ones, but yeah, thanks for everyone joining. And it's busy times in the market. Like I said, last week was a busy week. This week is also a busy week. Big moves being made in a lot of individual stocks here with earnings reports and lots of other news items coming out on a lot of companies. So the market as a whole is also ripping to new all-time highs. We have the S&P 500. It was up about 1.5% last week. The NASDAQ was up almost 2% last week. Europe was a little more flat. We did get positive results in Asia as well, and most of the stock indices there. So yeah, I mean, most major stock indexes in the world are up very, very nicely on the year, many breaking to yearly or multi-year highs. So despite some of the weaker economic signals or mixed economic signals we've seen over the past 3, 6, 9 months, the equity markets continue to trend positive. So yeah, that's interesting. So we're getting lots of opportunities here, lots of different stocks. Like I mentioned, I was just talking about oil and gas here is really getting some love today and over the last couple of days. Pretty big bounce here in Encana, for instance. One of the position changes I had last week was that I added to the Encana position below $4. So I think I had a couple trades around, I think, 392, 393 level. And today we're pushing up closer to 450. So pretty big move here over the last, I would say, probably the later part of Friday and then through today's trading session. I think Encana's up something like, I guess it's what's that? That's about from where I was purchasing it the other day, about 15%. So nice to see that. Nice to see it get a little bit of love. We're still, I think, well off where this stock can be from a longer term perspective. I think, Encana can definitely be an $8 to $10 stock again. So I'm holding my position long and strong. But it was nice to be able to add at those lower levels last week on Encana, and then the week before we had added to, I had added to Devon at about, I think, 20 or 21, somewhere in that range. And it's pushing 22.50 today. Still, in the grander scheme of things, you can see these names. When we zoom out on these charts, this was a $40, $50 stock not very long ago, last year, in fact. So I think there's still quite a lot of upside here. Oil prices hanging in there pretty nicely. Gas prices getting some love. So that's nice to see. Like I said earlier, gas prices here finally coming off the bottom there as we move into the winter season here in the northern hemisphere. It's been actually a colder than expected winter so far. So we see that gas prices are moving up closer to $3, and so that's helping these energy names. That was, I added to Encana last week in terms of other position changes. I sold Blue Apron too early, clearly, as these things often happen with my trades. When I finally decide that things are too ugly for me and I get out, that's when the stock seems to get some love. I'm actually okay with what I did here on Blue Apron from a fundamentals perspective. I think it was the right call to make. I think with the market strength, there's been some short covering in the stock, and so it's up about 10 or 15% over the last couple of trading sessions. I sold it, I think, at a modest loss to my cost basis. Actually, today it's probably either at or a little above where my cost basis was. But again, they had their earnings report last week. I read through the transcript. I went through the numbers. I didn't think that, there's enough positive things happening. Let's just pull up. I'm going to pull up the numbers here from their press release, and you'll see what I mean. So, I just didn't have confidence that this turnaround is really working. I needed something more tangible. So one thing that I noticed is that while they had swung to a profit in the first and second quarters, and free cash flow had been, I think, modestly positive, or maybe that was just the first quarter, I forget, but the last quarter or two, the trend has gone back the other direction. So you can see here, adjusted EBITDA is negative in this most recent quarter, and free cash flow is negative as well. So that trend is not great. When I looked at this in the first quarter, things were trending positively. Adjusted EBITDA had gone positive. Free cash flow had gone positive. There is some seasonality in this business, but nonetheless, the rate at which they're losing customers isn't slowing down. So if we look at, their revenue was down, net revenue decreased 34% year over year. So at this stage of the game, going into third quarter 2019, I would like to see the revenue declines actually slowing down, because the story there is that of course, they've been cutting back on marketing, and that's been hurting the size of the customer base as they churn off unprofitable customers. But at some point, that number has to stabilize, right? If they've got a core base of customers that are sticky, then that revenue growth rate needs to flatten out and actually become flat or positive at some point. Instead, what we're seeing is actually it's continuing to go negative. Even as the comparisons to the prior year get easier and easier. So you can see here the revenue growth rates as we trend through each quarter. Actually, let me switch it to quarterly. A negative 34% quarter here. That was about in line. It was negative 34% in the prior quarter, negative 28% quarter before that, negative 25% in the year. So this revenue growth rate year over year is declining at an even faster rate than it was even earlier in the year. So they're continuing to lose customers, even though the comparisons should be getting easier for them, if that makes sense. So that, to me, is a big negative sign that the turnaround really isn't quite working. And furthermore, the thing that really bothered me was when I read through this transcript of the earnings call, I didn't find anything specific that the management team was saying that got me excited or gave me any increased confidence that the the turnaround strategy is going to work. So this thing really depends on, this new CEO, Linda Kozlowski, coming in and shaking things up and creating new growth engines for this company. And when they talk about it, when the analysts ask them, well, tell us, more specifics, like, because that was one of the first few questions they ask is like, could you talk about the initiatives you're investing in? What product, partnerships, what are you working on? And they just sort of like talk about it very generally. Well, it's actually going to be a combination of things. It's going to be, a little bit of this, a little bit of that. We really want to give our customers more choices, make things more flexible. It's like, it's not very specific. Like, give me some specific things that you actually think are going to move the needle. Oh, yeah, we're working on more partnerships. Well, that'd be great. I would love to see you guys announce some more partnerships, but right now we don't see those things. So I'm having a hard time getting confidence in this turnaround strategy when I don't have anything concrete to really believe in. So maybe I'm too early. Maybe I sold at exactly the wrong time before things have had a chance to really, take hold as far as strategy goes. But management can't even explain the strategy very well. So that just really gives me some, questions as to like, can this thing really work? And of course, the numbers, like I said, just continue to get worse. So yeah, for now I'm out. I'm going to keep reevaluating this. I'm going to keep an eye on it. I'm going to keep watching what's happening with any announcements they have, any further have over the next couple quarters. I'm going to keep an eye on, but I decided that there are better places to allocate capital right now. So, that was kind of my thinking there. Was just I felt like the probability of the turnaround succeeding was lower than I thought it might have been back in Q1. So, was able to get out and preserve most of that capital. So that was kind of my thinking there on Blue Apron. Again, the stock has rallied in my face in the last day or two, but yeah, it happens. So the other thing that I did was last week I mentioned I sold some calls on the Urban Outfitters position that I own. So this is one of these retail stocks that I own a little bit of that has had a nice run. I think it was a small single-digit percentage of my overall portfolio. I think it was about 3% of my overall portfolio last week. And so, my average cost basis on this is in the low 22 range, 22.50 or 22.75, something like that. And we're pushing up to about $30 a share. So a nice gainer here. And I just felt like, with the market rallying to new all-time highs and, we're got a nice bounce, but there's still a lot of questions out there about the macroeconomic environment. We're going into an uncertain election season next year. I wanted to take some gains here, but I didn't necessarily want to sell the position, especially right before the end of the year, generate taxable implications there and things like that. So I thought about, okay, what can I do to maybe add some juice to this position or take some profits essentially without actually selling the stock. So I decided to sell some call options on it. And this is essentially a covered call strategy where you write call options or you sell call options against an existing long position. And this is a nice, this is a bit of a more advanced strategy, but I often do this when I already have a gain in the stock. And I'm going to pull up a spreadsheet here to kind of show you all what this looks like. So let me see if I can drag this over. So this is a kind of an example spreadsheet that I created just this afternoon to kind of give you an idea of what this looks like. So in this case, Urban Outfitters, the stock, trading, just under $30 a share, and my cost basis low 22s. I just use 100 shares in this example just to kind of make this example more simple. So if I had owned 100 shares at 22.25 cost basis, that means I paid about $2,225 for the position. And I'm looking to actually sell an slightly out of the money call option that's got a relatively near term expiration, because the way that options work, they actually have time decay, and that time decay gets gets faster and faster the closer the expiry gets to today. And so we want, as if we're selling call options, we want to actually benefit from that time decay, that accelerated time decay. So I chose the January 2020 expiry. That means this call option expires in the third week of January 2020, just a couple months away. And the strike price on that is, like I said, $30, which is just out of the money given where the stock is last trading. So the option's quoted at a price of $2.25. Now, an option typically covers 100 shares, and this one is true in that case as well. So the total proceeds of the option is the 225 price that I'm able to sell it at times the 100 shares. So the total proceeds of the option, which again, the option actually represents an option to, to buy the stock at $30. And I'm selling that option. So anyway, so again, it's 100 share multiplier times the 225 price means that by selling this option, I get $225. And so for every 100 shares that I own, I would sell one of these options. So in this case, I only own 100 shares, so I'm only selling one option. So the price of my shares that I paid at $22.25 was $2,225. The proceeds of my option are $225, and you can see at different stock prices what the total profit and loss of this position look like. So you can also see like what the profit and loss looks like just on the stock alone, and then what the profit and loss looks like just on the option alone. And then again, I combine those to get the total position profit and loss. So what I'm doing here is I'm essentially, you can see in the blue line, if I just kept owning the stock, you can see what my profit and loss would be at different stock prices, right? If the stock declined to 15 or 20 bucks, I'd be underwater. And you can see, by how much I'd be underwater at each of those. If the stock rises to 30, 35, I'm obviously this much in profit if I just own the stock. Now, when I sell the option, what that does, it gives me a little bit of income, but it also caps the level at which I'm able to profit on the underlying stock. Because again, I'm selling the call option, which means I'm selling the right to someone else to buy the stock at that price. So what the position profit and loss looks like on this covered call strategy is this red line. So I actually, even if the stock were to decline, I would actually have a lower break-even point. So if I just owned the stock, I would break even at my cost basis at $22.25. But now that I've sold this option for extra proceeds of $225, I've actually brought my my break-even cost basis down to about $20 a share. So this stock could decline to $20 a share before I hit break-even. So again, the trade-off here for having this extra income that increases my break-even price and increases my profit at each level is that I cap my potential gain off at the strike price. So when the stock rises above $30 per share, I no longer benefit from the rise in the stock. But again, the trade-off is that I get that income from selling the call option. So I know this is a little bit confusing. If you guys have more questions about it, we can address it. But this kind of just shows you that at expiration, what my profit and loss looks like in that covered call position. So again, what I decided to do instead of selling the stock was to actually sell a call option against it. And if the stock rises to $35, $40 a share, then the shares that are covered by my call options will get called away from me and I'll be forced to sell them. So, and that's fine because I'm okay with giving up the profit above that level. So that's kind of how the covered call position works. I take in some income and the trade-off is I give up any upside above a certain level on the stock. So yeah, that's kind of what I did there. That was, I think, the only other position change I had on the trade alerts last week. So, but we did have quite a bit of news and earnings on some of our, watch list positions. Macerich was one of them. As you guys know, one that I've been pretty bullish on. And the numbers actually look pretty good. I thought they reaffirmed their guidance for the full year. They did another 75 cents a share quarterly dividend, which means the dividend yield on that stock at today's prices is about 11%. So really solid dividend. They said in their comments that the leasing environment continues to improve. They've got the Fashion District Philadelphia, which is their new, one of their big new developments has opened. They've got leases executed on about 80% of that space, and they've got another 14% committed in active negotiations. So that property should be fully leased up probably in 6 months, I would guess. So that's doing really well, and they said that all the retailers in that development are actually seeing above expectations in terms of sales and things like that. So that's really good. They address some of the things that are going on with some of their tenants that people are worried about, like Forever 21, which is in restructuring. They did say that they will have a slight impact, probably about an 8 cents per share annual impact next year, assuming no positive developments from releasing that space. They would have a headwind of about 8 cents a share from Forever 21 renegotiating all their leases. But that's not really a big concern, and I think they're going to be able to mitigate most of that impact by the middle of next year. They also talked about the fact that like they've got a retailer like Charlotte Russe, which actually liquidated, and they had 26 locations in the Macerich portfolio. But the and let me just bring this up for you guys. So yeah, they have already leased 23 of those 26 locations in the last 6 months for Charlotte Russe. So, that just kind of goes to show you that whatever tenant problems they are having, their portfolio of developments and malls are strong enough that they're able to release them pretty nicely. And typically they've been able to release them at better rates than they even had before, which I know I've talked about in the past. They've been recapturing Sears locations, for instance, and turning them into like movie theaters and co-working spaces and multifamily real estate, apartments and things like that. So I don't know why this link isn't working. I've been having problems with links lately. I'm not sure if it's my system or what, but I've been having a lot of problems with investor relations links lately. So let's just go pull it up in here. So yeah, you can see, their sales per square foot is up 13% in the last 12 months. Releasing spreads were up 8%. The occupancy of their mall portfolio was down, and a lot of that has to do with those bankrupt tenants, and then also some of the new developments they've got. But average rent per square foot is up. So yeah, and they've been able to refinance some of their existing properties too and get lower interest rates. So these are all things that are helping results here. They're reaffirming their guidance of FFO, which is a really important REIT metric, of $3.50 to $3.58 for the year. So, typically high quality REITs will trade at like 15 to 20 times FFO. Now, if Macerich used to trade at that level. So again, if we could get back to like a 20 times FFO level, then you could be talking about a $60 or $70 stock again on Macerich. I don't think we get there in the next 3 months, but again, we get paid to wait here with pretty nice dividend yield. And I think over the next few years, assuming nothing crazy happens, then, I think this stock has a lot of appreciation potential still. So anyway, I thought the results looked pretty good here at Macerich. I didn't really have any major concerns. So I continue to hold the position and waiting to see if we'll get a deeper pullback. But yeah, stock was up 4% today, so it's rising along with the market. But I still think we could potentially get another deeper correction here if we get a broad market correction, because there's not a lot of positive sentiment with anything mall related, even though results here look pretty good. So I think we could potentially have a potential to own more of this thing in like the low 20s or something. But we'll just wait and see. And then Encana, which I was talking about a little bit earlier before we got the recording going. We are seeing a nice pop here. I added to that position. The results they released last week look pretty good. Just go ahead and bring them up. And yeah, you can see that they're really focusing, like a lot of oil and gas companies right now in the U.S. They're really focusing on trying to generate positive free cash flow, cutting costs and keeping capex down so that that they can pay down debt or repurchase shares, which they've been actively doing as well. So you can see here they completed their $1.25 billion share repurchase program. So they reduced share count by about 13% this year. So that's pretty significant. That means there's more of the pie that's going to us as existing shareholders. So that's really nice. And I think they've been buying back shares at pretty nice prices here in like the $5-6 range is where their average repurchase price was for this full year. And I think going forward, that'll look like a pretty good price, hopefully, for the company on a longer term basis. But yeah, they had cash flow from operations of $756 million. I guess non-GAAP was about $800 million. Again, this is a company that's got. Let's just double check their market cap real quick. Let's see, the most recent share count. Let's see if they've got the 10. They don't have the 10Q out for Q3 yet. Let's see if they've got the shares here in the income statement. Didn't see an income statement here, actually. In any case, this is, let's just check Koyfin and see if they've got it. I could go, actually, what we'll do is we'll look up last quarter share count and just use last quarter share count. Let's say 1.35 billion shares, let's say. 1.35 billion. And then if we multiply that by even today's price, like let's say 447, We're talking about a $6 billion market cap. And this is a company that just in one quarter alone is producing $800 million of operating cash flow. Now they do have significant capex they need to keep spending here in this business, but free cash flow I think is roughly about here in Q3 it was about 250 million. So if you annualize that number, we're talking about $1 billion of free cash flow, and it's a $6 billion market cap, so 6 times free cash flow. That's a really, really cheap multiple for any company that's performing well. So still a very cheap stock. And I thought the quarterly numbers look good. You can kind of see some of the metrics they're talking about here in the quarterly release. But they raised their production outlook, and they are continuing to reduce costs and continuing to focus on delivering shareholder value. Now it's interesting because I believe on Thursday or Friday they also announced that they want to move the headquarters of the company from Canada to the U.S. and they're actually going to rename the company. I thought the name of the company, the new name of the company, is kind of stupid, but they want to rebrand under the name Ovintiv, Ovintiv. I'm not sure where that came from, and I hope they didn't pay any consultants too much money to come up with this silly name, Ovintiv. But in any case, they want to move to the U.S. They want to move their headquarters to the U.S. Partly because they also want to benefit from a broader investor base here in the U.S., including index funds and passive funds, because they think their stock is underowned by like investment funds and index funds, and so they think that will help the valuation of the company. Management continues to think that the stock is undervalued. Like here they say, however, our actions show that we will leave no stone unturned to capture the value we deeply believe exists within our equity. So this is a move really to try to close what they perceive as undervaluation in the stock. I don't think the move to the U.S. Is going to increase the valuation that much. They might pick up a few additional index funds or passive funds that end up buying shares, but I just think it's just going to be a general recovery in the sector over the next couple of years that probably makes the biggest difference. But in any case, it's probably incrementally a positive move that they're moving to a domicile that does have a broader investor base. So that was an interesting announcement that we saw from Encana as well at the end of last week. But yeah, that all things considered, I thought the numbers look good. I continue to be positive on the stock. So let's hope this rally continues and this thing gets back to $6, $8, $10 maybe. So that was Encana. LyondellBasell also reported. I thought they had really nice results. That stock's been a pretty nice winner too since I issued the trade alert on it. Could have been a bigger position. Didn't make it as big as I probably should have, but hadn't really done as much work as I wanted to there. Let's see. I think it's on the list here. Yeah. But that's been a nice, a nice winner from, I think, what was it? Mid 70s where I alerted on it. So, up pretty nicely in that one. And, that one pays a nice dividend too. So I've got dividend income that'll enhance our return there as well. Who else? Let's see. I think EA, they reported results look fine. Nothing that really stood out to me. And then, the video game sector is kind of just chopping along this year. It hasn't been super strong. And I've kind of been waiting for the valuations to come in a little bit on that, but EA's just been chopping around between like 90 and $100 over the last couple of months. So, haven't quite been able to pull the trigger there yet. Who else? Let's see. One that was interesting that's not on our watch list that I was taking a look at last week was Grubhub. So that was a stock that really disappointed. This was a company that was down like over 40% gap down here on their earnings. One of the bigger earnings losers of last week. Recovering a little bit this week, but yeah, basically the results look terrible. They had a shareholder letter where they basically admitted that their business is really hard to be profitable in, and profitability has been getting worse. And competition's been getting increasingly tough from DoorDash and all these other food delivery companies that are offering incentives, and the business itself is tough because they have to figure out how to eke out profits on pretty small dollar transactions sometimes. And when you're driving, you're having to pay drivers to drive around and deliver things. It's it's a very small margin business, so you have to have a lot of scale. And Postmates and DoorDash and others, are pretty well capitalized and continuing to make life difficult competitively. So, and the stock still isn't really cheap from a valuation perspective, even after the fall. So, it's one I'm kind of watching. I may do a little bit of more work on, but it wasn't really on my radar. I kind of was avoiding that sector. Uber Eats, you could see when Uber went public in their S1, Uber Eats has been losing money as well, and they're still being aggressive as a competitor too. So it just wasn't really a business that I was super pumped up about. So that's why I kind of avoided it. But anyway, I think anytime you see a stock fall 40% in a day, it's always interesting. On the flip side, I think a company like Spotify actually had really, really great results. And this stock used to be on our watch list, but I had taken it off because I didn't really think there was a whole lot happening there that was super compelling. But this last earnings result looked really good, and they're accelerating their investments in things like podcasts, and that market for them continues to grow really rapidly. So that is contributing a lot now to the growth potential of the company, and they continue to gain some paid subscribers at a really high rate. I think they're growing revenue still at over 30% a year. Bring up the metrics. So just really executing really well. And I thought their earnings release, which I'll pull up here in a second, had some really interesting comments. About almost 30% year-over-year growth in the most recent quarter. Let's see. But I thought, the valuation's still pretty high. You got to believe if you want to make a really, really good return from these levels, you do have to believe they're going to be able to expand profitability and margins. The knock on Spotify has always been that, margins are really tight here because record labels and artists really have the leverage here in this industry, right? And so Spotify enjoys, record profits in a couple of years. When they have to renegotiate contracts with labels and artists, those labels and artists are going to cut into their profit margins again by, requiring higher percentages for royalties and things like that. So, at least right now, things are firing on all cylinders for Spotify. They grew their monthly active users at 30% year over year. Big growth in areas like India and Southeast Asia. Premium subscribers grew 31% year over year. Churn improved. They continue to call out the fact that they're executing better than any of their competitors. A lot to like here. I think when they talk about their podcasting stuff, and they are pushing more into offering artists valuable analytics and things like that. I think they eventually want to disintermediate the record labels. They want to be able to increase their margins by having artists go direct through Spotify more and more. So if that continues to gain scale, then this business could be a much better business a few years from now. So they're continuing to push forward in that area. And I think that's an area where a lot of investors are more excited about Spotify than they may have been, 6 months or 12 months or 18 months ago. So and then they actually have been repurchasing shares as well. They did $1 billion of share repurchases. So that's helping financials some a little bit as well, or at least offsetting their dilution. I forget exactly where they talked about podcasting in here, but they talk about that. Oh, here we go. They're seeing exponential growth in podcast hours. So podcasts are interesting because there isn't the dynamic of the music labels, though the same way that there is for music. So with podcasts, their margins actually should be pretty good. And they talk about that growing, exponentially off a small base, they said, but, quarter to quarter growth. This isn't even year over year growth. This is quarter to quarter. So from Q2 to Q3, which is obviously a very short time, it's, they saw 40% growth quarter over quarter. So growing pretty rapidly. And, I've been using it for podcasts, and I think it's becoming a really nice. They acquired a couple companies to try to increase their market share in podcasting. So that is a big focus for them, and it's I think a really interesting area to watch. So I don't know at what point I would buy the stock, but I'm gonna have to do some valuation work on it. But definitely from a operating metric perspective, things look pretty good there. And then let's see. Yeah, I've been spending some time looking at Twitter. I've got a big piece that I've been writing there because that stock had a 25% decline on earnings. Talked about that a little bit before, but I've got a piece coming out on that, and I think there's still value here. I'm just again, it's another one where I kind of need to figure out at what exact price do I really want to own this thing. But look out for that. Look out for that this week. I'm going to be putting that out on the newsletter. So I got some interesting thoughts on Twitter. But and as far as more market-wide stuff on the macroeconomic front, we had the Fed cutting interest rates here in the U.S. 25 basis points as expected last week. The jobs data looked really good on Friday, so that was helping the market. There were 128,000 jobs added in the prior month in October versus I think about a 90,000 consensus. I did see that the ISM manufacturing still looked really weak. Let's just see if we can pull this up. It was below 50, which is suggesting that the manufacturing sector is still in contraction in October, but did improve slightly from the month before. So maybe the trend is headed in the right direction. But consistent with a lot of the other countries, we're still seeing the manufacturing sector not doing very well. And then, personal income and spending data in the U.S. last week was another release that we got, and that was pretty much in line with expectations. There was slight growth there. We're seeing, GDP growing about 1.92% in the U.S., so not great, but, not horrible. This week, we don't have a huge macro week. I think there's a couple small things, like we get the ISM non-manufacturing data in the U.S. on Tuesday. And then there's a Bank of England rate decision on Thursday. And then we do get some stuff out of China. So we get balance of trade, import, exports, essentially coming out of China. And then Chinese inflation rate on Friday. And then we do get the Michigan consumer sentiment data on Friday in the U.S. So not a huge week. I will be watching this ISM non-manufacturing data because that's one area where I think a lot of people are trying to focus and see if outside the manufacturing sector, the uncertainty of the trade wars and the weakening manufacturing sector, is it going to spill over to the non-manufacturing stuff? And so I think it's important to keep an eye on what's happening there. And those numbers have been weakening a little bit, but they are still above 50, suggesting that that part of the economy is still growing. But yeah, that's coming out tomorrow. So again, this was the last reading we got was pretty ugly. So this one's going to be pretty widely watched tomorrow when it comes out. And then again, we have lots more earnings reports coming out. Again, you can look at the calendar, but there's a lot more earnings coming out this week. We've got, you saw companies like Under Armour and Marriott and Hertz and Shake Shack today. Tomorrow you get Booking.com, Match.com, Peloton. Wednesday we get Baidu, so that's going to be a big one. Baidu was up nicely today, but we've been waiting for some positive momentum there, and that'll be a big report on Wednesday. So I'll be watching that one very closely, and probably on the conference call as well. And then Square on Wednesday as well. So Wednesday is going to be a big day, I think, overall for tech. There's also Roku and Expedia reporting on Wednesday, so those will be some to watch. And then let's just pull up Baidu. So Thursday, GoPro, Dropbox. We get Dropbox on Thursday. That's another one I'll be watching closely. And then Zillow Group, which is on our watch list, that has earnings on Thursday as well. So those are a couple that I'll be really focusing on. And then we get a couple other big ones like Disney, Activision, Wynn Resorts on Thursday. And that pretty much, that's pretty much the big ones that I saw. There's a lot of other small companies as well reporting. So we'll be keeping an eye on those earnings reports as well. But that's kind of the major stuff this week so far. Under Armour was actually an interesting one. I mentioned that briefly, but this stock was down. This is one that I've long called out as an underperformer, and one that I think the company it's just been disappointing to watch. It's one I've kind of watched on and off, and I haven't ever had the confidence to own it because it's just underperformed. You look at a stock like Nike, a company like Nike that can grow at 9-10% year over year, and it's 8 or 10 times the size of Under Armour, and Under Armour is struggling to grow at all right now. I think they actually had sales decline this quarter, and they've got accounting issues that are being probed by the SEC, which they didn't really talk about in depth, but they mentioned it. Stock was down, about 20% today. So, this is actually one that I think at some price is going to be worth buying for a turnaround, because the CEO has stepped down. And I think that was a big part of their problem, is the founder CEO just didn't have the right execution and the right vision for the company. And so Nike and Adidas have been eating Under Armour's lunch in the past couple of years. And this is a company that's much smaller. Again, I think it's a $6 or $7 billion market cap company today. Let's just look. Let's just double check that. But, a company that's much, much smaller than Nike, growing much, much slower. They've got to be able to turn that around. And this company had a lot of potential, but it actually has 2 tickers because it has 2 classes of stock. So the market cap, at least it's saying on this, is about $7 billion. And I'm not sure if that's 100% accurate. It's somewhere in the ballpark, but we'll have to double check those numbers. But let's just say it's $7 billion, more or less, on Under Armour. And then Nike's at, Nike's much, much larger, $140 billion market cap. So, I think, and Nike's growing. Let's just look here. I think I've shown you this before, but Nike's growing at, and some of this needs to be currency adjusted. Nike has to deal with some currency headwinds, but let's just assume this is the organic growth rate for Nike, 7%, 4%, 7%, 9.6%, 9.7%. So, growing high single digits on a revenue basis, and actually earnings have been growing much, much faster. So net income's been growing mid-teens percentage. And you can see, like in the stock chart, the company has just done really, really well over the past 5 years. The stock has stock's been a double over the last 5 years. And versus Under Armour, which is, I think, gone nowhere. It's gone down in the last 5 years. It's actually gone down significantly in the last 5 years. So Under Armour just really, really underperforming versus a company like Nike. And I think given their much smaller size, Under Armour should be growing faster. There should be more growth opportunities for Under Armour, especially internationally. You can see revenue growth has essentially been like almost flat in the past couple of quarters. So pretty disappointing, but it's nice to see that the CEO is stepping down. Maybe they're going to clean up their accounting and finance issues. And at some point, maybe this becomes the potential to be a multi-bagger stock over 5 or 10 years. Interesting. So OCY, I think he's saying that he hasn't ever heard of Under Armour. So they're, I think that's one of the things that they've done poorly is focus on some of the international expansion opportunities. This is similar to Nike or Adidas, a performance athletic apparel and footwear company, and they make athletic gear, shorts, shoes, hoodies, dry fit stuff. Their whole thing is that they were the pioneer of a lot of the tight fitting dry fit type of materials that athletes would train in, and that became a huge hit about a decade ago. And let me just see if I can bring up this product, but I'll show you what they're like known for, which is their the kind of their compression gear. They also have made a big push in footwear. They've got The Rock, Dwayne Johnson, as a spokesperson. He's got his own line with Under Armour. I thought the actual product itself that they put out with The Rock was pretty piss poor. And so I think they kind of blew that opportunity. But this kind of stuff, like the compression gear for both hot and cold, that a lot of athletes use, and stuff that becomes like base layer type stuff. But they have not done a good job at executing in their business. So, but again, I think this one has the potential to be a multi-bagger stock when you look at the size of the company relative to some of the larger ones in the industry. And they actually do have a lot of interesting celebrity endorsements. Now they pay for a lot of those, but like Dwayne Johnson, The Rock, they've got Steph Curry. I think they've got like some golfers like Dustin Johnson. But let's actually, I'm gonna Google it. Maybe they've got a page, sponsorships. Tom Brady, I guess. Yeah, they have, and then yeah, I guess they've got some football teams or soccer teams that they sponsor as well. But they're definitely more dominant in the U.S. than they are in international, outside of the U.S. Yeah, Joel Embiid, Seth Curry, or Steph Curry and Seth Curry, um, Jordan Spieth, who was on the PGA Tour, was one of the leaders there over the last couple of years. So yeah, I mean, they're doing a lot um, to try to get inroads into the market through these sponsorships, but they haven't been able to translate that into broad success quite yet. So anyway, one that I'll keep an eye on, but I thought there were some interesting announcements there. Other than that, there's not a whole lot outside of like earnings stuff that I'm really looking at the moment. I just got a lot of stuff to filter through in terms of reports, and so not a ton of like new stuff on the radar, but trying to dig through the reports and really figure out what's changing, what might be interesting, what companies are faltering, which ones are doing well, and that's kind of what I'm focusing on this week. So so OCY is asking about Sunrun, which is pulling back along with SunPower, and I haven't really dug into it anymore this week. But now that these stocks are coming in, it's definitely high on the list. So it's now a little bit below my average cost. I think I alerted on it like in the low 15s is where I purchased my first lot. Still a small position for me, but I haven't seen any fundamental changes from Sunrun or SunPower, like no new news. There's obviously something going on with SunPower because the stock has been under pressure pretty severely over the last month, I would say, month and a half. You can see that the stock's been almost cut in half. Now, I thought SunPower was a little bit overvalued. This was, I think, a $2 billion market cap or so, or $2.3 billion market cap up here. And this is a company that's only producing EBITDA of, I think, somewhere between 50 and 100 million annually right now. Now, this is a growth industry, so I think the expectation is that SunPower should be able to produce about 200 million of EBITDA in about 2 years' time. But I thought the valuation that was being put on the company was a little bit aggressive for current numbers. So so I did think it needed to pull back, but this is a pretty deep pullback, so I'm not sure if this is warranted or not. But Sunrun has been a little bit more resilient, but it is pulling back a little bit as well. So it's pulled back about 25% from its annual highs this year. But this is still pretty close to the level at which I was buying. And, I think this is a really screaming value. If this thing gets to like low double digits or even single digits, it becomes a pretty screaming value, because at like below 10 or $12, you're buying it below the value of their existing contracts with the residential customers. So, that would be essentially a point at which you're getting the shares, you're getting the growth of the company, the future growth of the company you'd be getting for free. It'd be like a free call option at those types of prices. So I'm kind of hoping this thing pulls back a little deeper. But yeah, and again, I don't think Tiger's bought anymore. Let's take a look. Yeah, no new buys from Tiger since the beginning of October, but they've bought anywhere between like 12 and $17, I think, over the last year. Maybe even a little higher than 12. I think 14 to $17 is kind of the range they've been buying in. But yeah, I think, they issued some bonds. That was the only piece of news I've seen from Sunrun. Not a big deal. Yeah, it's about a 1% position size for me right now. And OCY, I'm not sure if you're asking how big is Tiger's position? Yeah, so Tiger owns, I want to say, like 20% of the company now. Let's look. Actually, we could look at the last Tiger filing. So if we go here to transactions and look at Tiger and pull up the actual filing, it should say how much they own. Yeah, so their beneficial ownership is, I think, 21 million. Is that right? 21 million shares? Sometimes it's a little tricky to I believe I may have to get into the footnotes on this. I could also, I don't know if Whale Wisdom is going to be correct on this, but we could pull up one of these sites that tracks the positions. Yeah, okay, so Whale Wisdom actually says that they own 29 or essentially 30 million shares of Sunrun now. So Tiger owns about 30 million shares. Let's look at their last share count. Last share count was about 118 million shares. So yeah, they own about a 25% position in the company. That's pretty massive. Tiger owns about a quarter or almost a quarter of this company. So it's pretty significant. They're taking a big bet, and for Tiger, I think it's become like a top 10 or top 11% position. We should actually get in about 10 days. The 13F filings from all these hedge funds are going to come out. The updated Q3 holdings reports will come out for all the major hedge funds in about 10 days, and so we'll be able to get an update and see. Any movements in these other positions of Tigers, we'll be able to see, how big Sunrun is relative to the other positions. So, yeah. They also, by the way, Tiger also owns some Fiat Chrysler and some JD from our watch list. So, yeah, JD's been doing well. So, yeah, company was up 5% today. It's finally in a nice breakout pattern here too. Yeah, Tiger had sold a bunch of Spotify. They'd cut their position by half as of the last 13F, so they missed that pop. So anyway, but yeah, that's a pretty big position to own a quarter of a company for Tiger. So. What other questions you guys have? Any other stocks you're looking at or wanting to take a look at? By the way, Nikki takes her CFP certification test tomorrow, so let's all wish her good luck, and hopefully she'll be on the weekly update with us again after she's finally done with this massive undertaking that she's been working on for the past few months. Yeah, just looking over our watch list. Yeah, CTT again is maybe taking a little bit of a breather after this big pop, but really nice run there as well. Getting a bounce in a lot of our stocks. Zillow Group is one that, again, I'm going to be watching for on their earnings report this week. Be interesting to see how this stock reacts. I've been really debating whether or not I should, enter into. I think I own a little bit now, but it's like relatively small at this point, and I'm debating at what price I really want to make this a meaningful position, because I think it's one of those stocks that could be a potential 10 bagger over the next decade, but it may have another 30 or 40% drawdown before it gets to the point at which it starts making moves up, because they have a lot to prove as far as the new business model transition. So that's one that I'm really conflicted on what the right price to buy at is. But we'll get more information on Thursday from the earnings results on what's happening with the business model transformation. So that's one I'll be watching pretty closely. Yeah, Apollo. So you bought some Ulta. That's definitely an interesting one. It had that huge 30% pullback. I've still got some text that I did for a quick video there. 25-30% pullback on that earnings result from the prior quarter, and it's trading at a much more reasonable multiple of earnings now. I think it's trading at 25 or 30 times estimated next year earnings. Let's look at what their estimates are. Yeah, actually cheaper than that. Now the earnings estimate for next year is about $13.45. That's the consensus estimate. Let's just assume $13 a share. So at $2.37 today, it's trading at about just over 18 times next year's earnings. And again, this is a secular grower, so that's a pretty reasonable multiple. Let's look. I guess the question is, are they going to see a massive deceleration in their growth? But yeah, as of last quarter, they were still growing revenues at 12% year over year, which is a pretty healthy rate for a retailer. I've always been concerned about Ulta because I know they have a lot of like strip center type of locations, but they do also have a really, really strong online presence, and they've done a really good job of bringing in popular brands into the store and into their e-commerce offerings. So it's probably one I need to pay closer attention to. This pullback may have been the opportunity to really take a position. It does look like it's kind of stabilized in price at these levels. I don't know. Let's see when their next earnings release is, if they've announced it yet. Yeah, so they last announced their second quarter results on August 29th. So it'll probably be at the end of November or early December when they announce their Q3 results. So we're probably about a month or either 3-4 weeks away from getting their next quarterly results. Yeah, let's look at their multiple over time. Actually, I want to look at their price to earnings multiple, the history of it. We'll look at their forward price to earnings multiple over the last 5 years. Yeah, so I mean, 18 or 19 times forward earnings is pretty much the lowest multiple that it's traded at in the last couple of years. Like it also had dipped down to that level, I think, the beginning of 2018. But more or less, it's been in the 20s or 30s over the past 5 years. Now, we do expect these, especially with these fast-growing companies, as they start to decelerate in growth, we do expect the multiple, forward price to earnings multiple, to eventually decelerate. But 18 times is maybe a point or two above the market average. So it's really not, even if this thing is on a decelerating trend, it's really, today's levels are really reasonable, I think. So yeah, Apollo, I think Ulta could be an interesting one. I think you might have found an interesting one here. Yeah, and so Apollo was also asking about TripAdvisor when I'd be looking to buy TripAdvisor, which is on our watch list, and that's one that has been under pressure for a while now as well. You can see this if I zoom out on the stock chart, and particularly since the start of the year, it had this nice pop last year, and then it's pretty much been a dog this year. Sold off from about 60 plus per share down to mid 30s a couple of weeks ago. Yeah, the problem that I have with TripAdvisor is that I feel like it might still be too early. From a fundamentals perspective, they're having the same problem that a lot of companies are having, where Google has been pushing them, the organic search results where they do really well, they've been pushing them increasingly down. And that's hurt their ability to acquire users and get users to transact through the TripAdvisor site. So, yeah, it's been a headwind for them. Now they are doing really well with their attractions booking business, which is essentially they're enabling people to book attractions for trips through their site now, and that business has become meaningful for them, and it's growing fast, and they're one of the big players there. So similar to like Airbnb experiences, if you've ever used that product. So that's a big growth driver for them. And that's, I think, part of the business that's going to continue doing well. Let's see if we can pull that up as well. But the hotel booking business, which is a big driver of the current profit, the trends have not been great. So let's see if we can pull up their investor presentation. So that's kind of been one thing I've been waiting on. Now the valuation isn't super aggressive. So it's not like super cheap, but it's also like not very expensive. So that helps. But yeah, they talk about the tours and activities market. That's what I was just talking about with the experiences stuff. So the online penetration of that is still really low, and they see a huge opportunity there still. And this is a site that still gets a ton of traffic, and they do participate in paid ads on Google as well to try to drive traffic. But the shift from organic to paid is hurting their margins. They actually have been on a decent trend though. In the past couple quarters, the margins have gone back up. Yeah, so I have a hedge fund buddy who does really like the stock at these levels, but I've been, my opinion has been that I think, see here, you can see it in the revenue growth, even though the margins in the hotel business have been improving. You can see Q2 2019, the revenue for the hotel booking business is 254 million. And in the Q2 of the prior years, it was like 270, 280 million. So the growth is negative in that segment. And that's still the biggest driver. You can see of the consolidated revenue, they did 422 million last quarter in revenue, quarterly revenue. And about half of that was the hotels part of that. So experiences and dining, which is growing really rapidly, growing almost 30% year over year. It's still significantly smaller than the hotels part of the business. So my concern has been this shrinking in the hotels revenue business. So I've been waiting for that to stabilize a bit more because it's been getting increasingly worse. So that's kind of what I'm waiting to see, is if this number starts to flatten out or grow again, then I'd be a lot more excited about TripAdvisor. I'm just worried that if this growth rate keeps getting worse and gets even more deep negative, then this segment is going to be a real headwind on the business. But yeah, I mean, you can see though that the margins, they have improved the margins, so the EBITDA is actually up year over year in that segment. I just think they're going to find it hard to continue to do that if revenue keeps declining in the hotel segment. So that's really my biggest concern. But there are a lot of positives, like I said, happening, especially with the booking the digital tours and activities stuff is still a big opportunity for them. Yeah, let's pull up their reported numbers real quick. Yeah. I mean, so revenue growth has just been sort of anemic, with the high growth in the tours and activities offsetting the decline in hotels. And then on an EBITDA perspective, EBITDA has been growing, but I'm just concerned that trend may end if the hotel's revenue keeps declining. Valuation looks like about a $5.7 billion market cap, assuming those numbers are right. I haven't looked in a while, but net cash on the balance sheet though of 700 or 800 million. So you're talking about an enterprise value around 5 billion, and pretty nice cash flow generator. Let's look on a trailing 12-month basis, generating just north of 400 million in cash flow from operations. Not a lot of capex in this business, 50-60 million of annual capex. So let's assume like 350 million of free cash flow generation. It's trading for an enterprise value to free cash flow. If I take the market cap and I exclude the net cash, it's about 14 times free cash flow, which is cheaper than a market average. So I think it's a pretty cheap multiple. It's definitely not an expensive multiple. So I guess it really all comes down to what the future of the hotel business looks like, because we know the trips and experiences thing will probably continue to grow, even if that growth rate decelerates over the next few years. And that should be producing incremental profit and cash flow. And then it really comes down to what's going to happen in the hotel business. Can they stabilize it from a revenue perspective? If they do, then 14 times today's free cash flow is going to look pretty cheap. That means, they should be able to grow free cash flow over the next few years. And then that makes the stock look pretty cheap on a multi-year basis. And estimates look right now, let's look at revenue. And you can see the trend of revenue estimates have been going down. So, analysts have their estimates of the revenue generation is getting worse. But they do expect growth. Like 2020 is expected to be growth over this past year, and then 2021 as well. Let's see what they estimate for EBITDA. Next year's EBITDA, 520 million. Year after that, 570 million. I don't know if earnings is a good figure to use for TripAdvisor, but growth from this year of about $1.80, $1.90 to over $2 next year, and then $2.40 then a year after that. So, analysts are expecting growth, but those estimates have been coming down over time. So that trend is what's worrying me. You know what though? I will. I know my buddy who works at another fund has spent a lot of work and a lot of time on TripAdvisor. So I'll ping him this week and see if I can get some comments from him and what he thinks about the future trajectory of the hotel businesses and if he has any insight there, because I do think this is one that could at some point become a position. Cool. Well, unless there's any other questions, y'all, I think that's probably a good place to cut it off today. We've been going about an hour. Awesome. Well, enjoy the rest of your afternoon and evenings, everyone. And I'll see you in the channel. Hit me up if you have any questions, as always. Take care, guys.